There's a guy who has worked for OpenAI and ChatGPT, he's worked for Sam Bankman-Fried and FTX, and he just raised his hedge fund to over $40 billion in valuation. That is the fastest growing hedge fund in the world. The only thing is that he just destroyed his hedge fund overnight, and this is what happened. The hedge fund is called Situational Awareness, and it's run by a guy named Leopold, where his goal was to invest in AI early before everyone else was.
He helped run Sam Bankman-Fried's philanthropic arm of FTX. He worked at OpenAI for a couple years, then got fired.
Now here's the thing that makes all of this even crazier. He's only 24 years old.
Leopold is 24 years old. He runs a hedge fund that had $45 billion in assets.
He was known as one of the greatest investors of our generation until this week.
But what's gone down in the past few days is them needing to sell off assets in order to meet margin calls.
So in this video, we're going to research and find out what happened to this hedge fund that made it collapse overnight. And not only that, but also expose the secret player that you wouldn't even expect to have some type of outcome on the game. But more on that later, because first let's start to understand who this guy was. After getting fired from OpenAI, Leopold decides to release an 165-page document titled Situational Awareness, the Decade Ahead.
His claim to fame is the manifesto Situational Awareness, which really put him on the map.
Understanding that AI will need infrastructure, and the companies that can supply that infrastructure will grow throughout the next few years.
Within a year, Nvidia data center revenue has gone from a few billion a quarter to 20, 25 billion a quarter now, and continuing to go up. Big tech capex is skyrocketing. The AMD, I think, forecasted a $400 billion AI accelerator market by 2027. I think it's, and AI accelerators are only part of the expenditures. It's sort of, I think sort of $1 trillion of sort of total AI investment by 2027 is sort of we're very much on track on it.
Here's a pie chart of his portfolio holdings. And as you can see, look at his top biggest holdings. Let's look at the top three, for example. You have Bloom Energy. Bloom Energy is a company that produces electricity for power generation in data centers, something very important to AI.
They have a technology called solid oxide, which is, for data centers, turns out to be a good fuel.
Next is the company SanDisk. It's been around forever, founded in 1988, and it manufactures memory products like memory cards, USB flash drives, and SSD drives.
And SanDisk has done phenomenally well, up over 3,000% since it was spun off from Western Digital last year.
Then finally, we have to look at CoreWeave, which is a company that specializes in cloud-based GPU infrastructure to AI developers and enterprises, creating the chip management software for these AI companies.
My job here is to drive value and take advantage of this generational opportunity to build infrastructure in a global build out of compute.
All of these stocks have been up tremendously, like SanDisk being up 3,000% over the last 5 years, CRWV being up 80% over the past 5 years, and Bloom being up 869% over the last 5 years. Obviously, these three companies being your top biggest holdings means that you're going to be a successful hedge fund, but where did it all go wrong? First step that led to the downfall of everything. It started exactly where he was successful. These three, as your biggest holdings, have taken a significant step back over the last few months. SanDisk being down 45%, CoreWeave being down 27%, and Bloom being down 30% just over the last 30 days. So this hedge fund, this is the positions that he had, and as you can see that there were some short positions too. So he was 4 times levered, and then he had shorts, so he's betting that stocks were going to go down on certain stocks, and those stocks started to go up. So the stocks that he had bought with 4 times leverage started going down, and the stocks that he had bet were going down started going up, and it ruined the hedge fund completely. So these stocks that have been up 1,000, 2,000, 3,000% over the last 5 years now just took a 30% decrease in 30 days. But what caused the hit? What caused the dramatic fall that these AI stocks have taken?
You know somebody has to liquidate. The best thing for you to do, unfortunately, sadly, Darwinian, is to go sell all the positions you have in common and then go start shorting everything they have. Yeah. And it accelerates the the sort of downfall as quickly as you can. And this is a very common practice when these things, happen.
Citadel ended up releasing a statement saying that they believe that the Federal Reserve is going to have a surprise rate hike. So these AI and semiconductor stocks ended up selling off rapidly, going down in price because of the fear for a rate hike.
Ken Griffin decides, the Federal Reserve is going to raise rates. The stock market's going to crash. And then Federal Reserve FOMC starts and it says, Kevin says, no, we're just going to keep rates exactly where it is.
Which put extreme pressure on situational awareness. So whether Ken Griffin and Citadel actually believed that there was going to be a surprise rate hike doesn't even matter, because no matter what is that situational awareness was put into a position where they need to sell. But it's not like he didn't have a plan for if things could go wrong. He thought about, okay, what if things would try to go to zero? And this was his plan for that. The two ways on not to blow up, he says one is AGI has to work, which is his big bet that he's putting on everything.
Obviously, you can't, not blowing up is sort of like, task number 1 and 2 or whatever. This investment firm is going to just be betting on AGI, betting on AGI and superintelligence before the decade is out, taking that seriously, making the bets you would make, if you took that seriously. So, I think if that's wrong, firm is not going to do that well.
So he's the one who told us this is how you don't blow up. This was his own strategy on how to not blow up. AGI has to work in timing.
The thing you have to be resistant to is you have to be able to resist to get one or a couple or a few kind of individual calls, right? It's like AI stagnates for a year because of the data wall, or you got the call wrong on when revenue would go up, and so anyway, that's pretty critical. You have to get timing right. I do think in general that the sort of sequence of bets on the way to AGI is actually pretty critical, and I think a thing people underrate.
But timing is the exact thing that caused everything to fall. He was over leveraged during a time period where he couldn't afford to be over leveraged, and that is what killed the whole portfolio. The one thing that he was missing on how to not blow up is the exact thing that caused him to fail, and that's leverage. He was over leveraged on his positions. He bet too much on himself. He doubled down on the wrong things. And because of that, he lost everything.
No matter how much people want to learn the lesson of leverage over and over and over again, we all seem to repeat it. And, it is what it is.
He lost his reputation as a hedge fund manager. He lost his reputation as one of the best investors of the decade. And now he has no idea where to go for his next step. So once Leopold found out that his fund was actually at the brink of collapse, he decided to write a letter to his investors. And this is what it looked like. This is where he said things stand. The portfolio experienced a significant drawdown over the course of July, which was exacerbated by extreme moves in core positions over the past week. We worked to keep the portfolio within our risk parameters, but gradually this became more difficult as positions rapidly moved against us and market liquidity dried up. So we traded a portion of our public portfolio in a block transaction to remove all leverage from the fund and prevent further losses. All shorts were closed and reliance on portfolio financing removed. This restored our stability and allowed us to preserve our private positions, which proves that the reason that this all collapsed was because of one, things that he bought took a downturn, and two, his leveraged positions ended up failing as well. So they had to sell the leverage in order to rebalance the portfolio and preserve the capital that they have. The thing is that when you have a portfolio that can't handle the loss that it's taking anymore and you need to liquidate, you need to sell your position, you can't just sell it to people like me or you. He's not just going to hit sell on Robinhood and be able to sell all of his stock. He has to find somebody to sell it to. There were 3 funds that were included in this offer.
They had conversations with Millennium, with Jane Street. Citadel is the one that got the deal.
There was only one fund that ended up buying the books for situational awareness. And who's the fund manager who owns that? His name is Ken Griffin. And Ken Griffin is popular because he was known for the guy who bet against GameStop. And all of the people on Reddit were saying, we're going to go against Citadel and all their short positions and push the stock higher. That happened all the way back in 2021. So Ken Griffin is back again, and he's the guy who's bailing out Leopold. But here's the thing. Ken Griffin is moving in a type of way that we haven't seen before, and it's actually a move where he's playing chess while everybody else is playing checkers. He's playing the long game while everybody else is playing the short game, and here's why.
This is what Ken does. He jumps in when you see firms in distress, gets a good deal. We've seen him do this many times in the past, either buying up assets at a distressed firm or taking talent. So this is part of his playbook. It's what he does.
Millennium did put in a bid. Citadel's bid was better. You know, I think Ken wants to be the guy that everyone goes to when they're in trouble. And that's the, you know, Buffett is getting older. This is not the kind of stuff Buffett wants to do anyway. But, you know, Citadel did this in the Amaranth deal. You know, when Amaranth blew up natural gas futures, I think Citadel took that portfolio.
You have to think about it like Ken Griffin is leading Citadel to play a game that's similar to Slither.io. If you've ever played that famous game where the ones who fall get absorbed and whoever absorbs them first ends up growing larger. And that's exactly what's happening with Citadel. Every few years, there's a fund that goes under that needs bailed out, and Citadel is there to recover it.
One of my partners received a call from one of the two heads of Soad Asset Management, a competitor of ours based in Boston. Soad had a very large and complex book of credit-related instruments. And as the credit crisis started to unfold, they found their portfolio did not behave as expected. They had lost hundreds of millions of dollars in the blink of an eye, and they needed to liquidate almost all their portfolio before the open of business on Monday. To acquire some or all of their $30 billion portfolio overnight was going to be a Herculean task. 6 a.m. before the opening of the markets, we bought that entire portfolio. Which brings me to a quote that describes the ethos of Citadel. Things may come to those who wait, but only those things left by those who hustle.
So Leopold had to find every reason on trying to keep the fund alive, and the only answer left was to sell a portion of their public holdings to a company so they could remove the leverage. Meanwhile, Ken Griffin's plan is to allow the best position for them to swoop in and grab all that stock at a discount. And because of that, there's two things that happen. One, Leopold needs to move on. He needs to move on and drop leverage, which is what he says he plans on doing. He said that he plans on removing investing in leverage completely and only focus on owning the stock that he has. The fund will continue on, but they will only focus on investing in actual shares of companies, getting into ownership, and not using leverage. And two, this means that Ken Griffin can continue playing the game of chess, the long-term game of outliving a lot of these funds and then collecting whatever they're able to acquire. And then that leaves the final piece of the puzzle, which is the state of the AI boom.
What's going to happen next is really going to be fascinating. There's some theory out there that we see all-time highs again now that all this liquidity is out. And there's other theories there that we actually were just having this nice big downtrend and that this liquidity pop will fade and we'll be back down further and further.
And a lot of people believe that we're in a bubble. And eventually that bubble is going to be popped. And there's a chance that the fall of this hedge fund is a direct sign of the AI stock boom finally coming to an end. I'm sure this isn't the last we'll see of Leopold. I'm sure he'll try to make a return somewhere. As a hedge fund manager, I don't know. But no matter what, we'll keep an eye on it and I'll let you guys know about it in a future video. Until then, I'll see you guys in the next one. Have a great day and goodbye.